Cinthia Muphy joining me, investment strategist, TMX Vetify. Cinthia, great to have you back.
Hey, good to see you. We've all seen enough market downs.
So yeah, that's kind of what we're going to talk about here, because our reliable trades in the stock market have been generally weak on these earnings. It seems like Broadcom is going to be another one here. Can't imagine the market's going to reward them for a miss. Staples, utilities, like defensive stuff within equities has been doing pretty well. From your perch, ETF expert, are you seeing that in flows?
100%, like financials. I mean, you saw last week the big story was Berkshire Hathaway, the new $1 trillion company that is not tech, the first of its kind. That's a financial stock. We're seeing financials being the best performing sector. The appetite is going for defensives. I mean, at Vetify, we collect a lot of behavior data, engagement data, and we've been picking up on this increasing advisor research for diversifiers, for de-risking, for assets that bring that level of safety outside of your mega cap, mega growth, mega everything story that's kind of losing steam.
It's a pretty stark shift, because in many ways, a lot of those big tech companies almost acted like safety. I mean, for a while, Apple was trading alongside bonds on days. I mean, did it build this great correlation statistic? Maybe not, but we witnessed it a lot, where it was a pillar. So do investors want to stay within equities? Do they believe that these other sectors are really going to be sustainable if times get rough?
Yeah, that's a great question, and I think nobody has watched it more closely than you have, just the whole AI story. So, the growth of AI is going to be here to stay. It's just very long term. Like any great theme, it takes a long time. So I think the market is taking a moment to digest that enthusiasm to now maturing segment, and that has slowed down the performance. The earnings kind of didn't really impress.
So still inflows, but just slower?
Yeah, it's still, nobody's bailing on their NVIDIA exposure, but there's some profit taking there, there's some reallocating. So I don't think that play is going to go away. It's just maybe time to broaden a little bit and diversify your exposure, include some of the other 493 stocks outside the Mag 7 that may do some performance here going forward.
How do people view, you think, the way to diversify within equities? Do they go and get these specific targeted kind of sector theme plays, or just go for like an equal weight basket, or like one of these more kind of actively managed defensive funds? What's popular? What's the way to do it?
Active management has really risen to the top here. Things like, if you think of something like DUSA, for example, Davis Advisors. So it's kind of that select equity. It's a basket of really interesting mix of stocks that may not go together otherwise. So looking for that quality, your Q growths, from American Century, those kinds of tickers are resonating, that look for cash flow names, that's safety and that fundamental strength, some of that value tilt. So the good thing about ETFs is there's a flavor for everything, so there's not a one tried and true effort, but there's many ways folks are finding to stay invested, but look more quality, look fundamental strength, look a little bit of valuation focus, a lot of value focused right now, away from growth. Those kinds of opportunities are resonating.
So applying some kind of like quality screens, value screens. We had a conversation earlier about a new ETF, ITWO, which just launched today, which is a covered call on the Russell. What about kind of the options-driven strategies, like the covered call wrappers and stuff? Are those doing well?
That stuff is on fire.
Right? It feels like it. How many guests have we had?
It dominates launches, it dominates demands, it dominates, it's almost like ETF investors have discovered options.
Totally.
They're no longer scary.
I mean, that's kind of why I ask, is it getting saturated, or is there just insatiable demand?
Just when you think we've had enough, is just a new provider comes in, they launch something else, a different type of index. It's nonstop. It's that appetite for the equity income through options has been crazy. And it has delivered. That's the thing, that we haven't seen any concerns with capacity, any concerns with saturation. So as long as investors are buying and these funds are delivering, providers keep bringing them more to the market.
I guess it kind of makes sense as almost a derivative on the ETF. In theory, you could take like every existing ETF, whatever it's investing in, apply an options wrapper to it if that's what you want. So it seems like maybe there could be like an infinite string of these things coming.
Yeah, it's product development on steroids in this category, and we just keep seeing more and more launches coming in. So I'm not sure that we've scratched the surface there yet.
Bonds, what are you seeing if we go outside stocks? Because it really looks like everyone wants to buy bonds right now.
Yeah, so bonds have been a little puzzling to me because I can't pinpoint where it's going. I've seen go into duration. I've seen go into aggregate type bonds. I've seen go into ultra short funds. And so I am wondering if this is a bit of harvest loss playing here, tax harvesting losses before rates go down. And people are just kind of replacing those positions, locking up those losses and reallocating that capital into different types of bond funds. It's been a little bit all over the place. We've seen a little bit more appetite for duration than for credit, but there's a lot of pursuit of yield at this point. So it's been a big segment for money movement lately.
Commodity-wise, do folks view this as a diversifier, or if this whole regime is shifting because inflation's coming down, economies are slowing, then does that work as well as like a diversifier as it did maybe a couple of years ago?
Commodities are interesting because they are the one thing we've seen advisor researching the most recently in terms of uptick relative to everything else based on our data. And, a little bit has to do, we're going into harvest, so it's a terrible time for commodity prices because it's abundant supplies everywhere. That said, you've had the folks here from Tucrium, for example, they're talking about the beginning of a new golden cycle because we're hitting near or at production cost prices across these commodities. So this is a little bit about a story about very minimal downside risk at this point. So a lot of folks are looking at commodities as that diversifier because even though prices are going to remain pressured through October, you could have a very, very low downside risk as costs are already so low. And then at that point, if the experts at Tucrium are right, this is going to kick off another big, beautiful cycle in commodities. So we see folks positioning for that.
There's definitely a thesis overlap between the commodity bulls right now and like the small cap bulls, where they're kind of like, hey, we might not get the timing perfect, but this should be like kind of a bottom process. At least that's the thesis. Cinthia, great to catch up.
Yeah, it's good to see you.
Always a wealth of information on ETFs and what people are doing. Thank you very much for the perspective. Very helpful to watch flows and know what's hot.